Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. Maureen, if you could please freeze the video, that would be great. And we can get going. So 1 million by 1 million, as you probably know, since you're here through our website and other internet presence, 1 million by 1 million today is the only global virtual incubator. And our mission is to help a million entrepreneurs reach $1 million and beyond in annual revenue, build $1 trillion of global GDP and 10 million jobs. Now, in support of that, we do a ton of different kinds of work. This particular roundtable session is one of them, and this is our 205th roundtable. What we typically do is showcase 3 to 5 entrepreneurs and have them do their presentations, and we discuss their businesses. Today we're going to do something slightly different, just to kind of play around with the format a little bit. There are various different topics that are in the consciousness of our community right now, and I've just written a bunch of pieces on those. So what I would like to do to start with is to discuss some of those topics. So what we will do is we'll put up a topic in the public chat, and there's a short blog post around that. So what we'll then do is discuss that particular topic around that blog post. I'd request you to go to the blog and go ahead and check it out. And then we'll come back here and have a discussion around that. You can use the public chat to share your point of view, your questions, your comments, your ideas, your thoughts, and I will facilitate the discussion. How does that sound? It's a little bit of a departure from our regular format, but we just thought we'd play with the format a little bit since we do the same thing every time. Okay, so let's actually go to the list. Maureen, if you could put in, are we in an accelerator bubble, the link for that particular blog post in the public chat, that would be awesome. And folks, you will find, make sure you set your chat to send to all participants so that you are able to see everybody's comments, and you're able to share your comments with everybody who's on the call. So the first topic we're going to discuss today in the roundtable, in a roundtable format, is, are we in an accelerator bubble? The blog post is on your public chat, so if you could please click on it and take a quick look at it. It's a short piece, and then we will discuss it. Meanwhile, the event is being recorded. The recording will be available for you at our YouTube channel and on the blog after the show. Our Twitter handle, if you are following us, is at 1M by 1M and at Sramana. And if you're live tweeting the show, please use hashtag 1M1M. Feel free to live tweet anything you like from these discussions or from what you're reading or asking questions about, using the hashtag 1M1M. Now, the YouTube channel is at 1M1M Roundtable, folks, and you will find instructions on how to, actually recordings of all the sessions in the YouTube channel. And these instructions are instructions to call in. So any of you who would like to call in and talk and ask questions, discuss, you're welcome to do so. Just let us know in public chat that you are calling in. Make sure you put your computer on mute, and the number to call in is 1-650-479-3208, access code 664-764-974. Make sure you keep your phone muted until I ask for you, so that you don't echo, stream echo into the call. But other than that, anyone can call in at any point you like to. You don't have to call in, Alex. You can use the public chat to ask your questions or participate, no problem at all. And by the way, folks, those of you who are in the room and are participating, please also introduce yourselves. Tell us where you're joining from, what project you're working on, so that we get to know you a little bit as well. And then feel free to discuss any of the issues that we are bringing up. So the first topic on the board is, are we in an accelerator bubble? I don't know how many of you read this Economist article recently. There was a special issue in the Economist about you know, a whole series of topics on what's happening in the startup world, how digital startups are booming all over the world, how accelerators are booming, and they quoted this number that there are, you know, more than 2,000 accelerators that have sprouted up. The number I have actually from the National Business Incubator Association is that there are more than 7,500 incubators out there. So if you extrapolate across those numbers, we're talking somewhere between 7,000 to, you know, 8,000–9,000 incubators / accelerators out there. And you know, a lot of people are asking the question, are we in a bubble? So this is a post that basically discusses the you know, what's happening in the incubator world. And while you're reading it, I'm just going to summarize a few points about what's going on from my point of view. So yes, there are lots of incubators and accelerators out there. And if you study their models, most of them are running these relatively short programs, 3-month kind of programs, and they take equity in the companies in their portfolios. And some of them give a little bit of funding. So it could be a $15,000, $20,000 to $25,000 bit of funding. And their whole game is, within 3 months, they want you as the incubatee or an acceleratee company to raise funding. If there's somebody on the call, if you could please put your line on mute, that would be great, because otherwise we're going to hear echoes. All right, so what I was saying is that this model of taking equity in an accelerator, in a company by an accelerator, by putting in a little bit of funding, and then within 3 months, the expectation is that the company is going to go out and raise its seed round of whatever, 100,000, 200,000, 500,000. This is the kind of modus operandi of the incubator accelerator industry. And in my opinion, that is a flawed model for a variety of different reasons. One of them is you cannot really achieve product market fit. If you're really trying to figure out whether your idea works or not, it is really not viable to find product market fit in 3 months. You could find it, but it's not a given that you will find product market fit in 3 months, and certainly not, you won't make enough progress to be able to qualify to be funded. That's number one. Number two is, not all businesses are fundable. You know, there are lots of businesses that can be very nice, robust, 2 million, 5 million, 10 million, 20 million businesses, but they're not necessarily going to be fundable, because funding, the venture funding model, is the domain of billion-dollar business ideas. That means that the entire ecosystem, the entire incubation acceleration ecosystem, is forcing all entrepreneurs to pursue a certain model which applies to less than 1% of, you know, companies out there. And that is almost setting people up for failure. They're not only setting these companies up for failure, they're setting themselves up for failure. And as a result, there are actually a number of incubators and accelerators that are failing right now and will continue to fail, because this model is just not going to work. This is what the article that I just shared with you is all about. I believe there are lots of other people who joined. Maureen, maybe you want to put the link one more time, if you would. Are we in an accelerator bubble? So this is the topic of discussion at the moment. Folks, those who have just joined, today we're trying a slightly different model. We are taking a few topics and we're going to discuss them, and I'm going to give you an associated blog post for each of those topics if you want to go and read up on it. So meanwhile, we have already launched the discussion on, are we in an accelerator bubble? So it's your turn. Any of you have any comments, points of view, questions, please feel free to chip in while I take a sip of tea. Anybody? Questions, comments, thoughts, ideas? And folks, also please introduce yourselves. Tell us where you're joining from, what are you working on, what your project is, and so forth, so we get to know each other. This is, after all, a roundtable. It's as much of a networking opportunity and discussion opportunity and getting to know one another opportunity as anything else. It's also a mentoring session. So if you're struggling with any of these, please come and discuss it. The telephone call-in instructions are all on your screen. If you want to call in, you can do that as well. Nobody has any question, comment, any point of view that you want to share?
Hi, Sramana. This is, can you hear me?
Yes.
Yeah, this is Rupesh Varma. I'm with Oracle.
Yes, hi Rupesh.
And, hi, how are you doing?
Good. Go ahead.
So, yeah, I just wanted to introduce myself. And what is the question again? Are we in an accelerator bubble? Is
Yes.
that the question?
That's the question we're discussing for the moment. Yes. We'll do a few different topics today.
Okay, yeah. Yeah, I mean, I would say, I think, definitely, I think accelerator bubble, I would think, is kind of overhyped. I mean, I know somebody, like I'm based in Ohio, and, you know, we have some accelerator here. One of my friends, he got selected into it, and you know, they were asking for some 6% equity, and then he didn't go through, and you know, without that, he was able to do pretty well. You know, one of my friends whom I met in MBA. So I think, but then of course.
Point about equity, and that's one of the things I have said in this article is that equity and incubation, acceleration kind of needs to be decoupled, because if you, so if you're really incubating a company, as we do, you know, we often work with companies that are absolutely zero stage. There is no idea even that is even remotely validated. There is like a very nebulous beginning of an idea that you know, is just starting to germinate. This is not a point where you can value a company, right? So, and you don't even know whether this idea is even fundable or anything. So this is a point, and an entrepreneur should not be selling equity. And 6-7% equity without any idea about what is the real destiny of this idea is just a flawed model, in my opinion.
Exactly, yeah.
We don't take equity, by the way, folks. All those of you who are, you know, looking at the 1M program, we have categorically, we're probably the only accelerator. You know, we call ourselves incubator accelerator because we do both incubation work as well as acceleration work. A lot of companies come to our program that are further along, have already got some revenues and are trying to grow that revenue and accelerate that revenue. And we also work with absolute zero stage companies. And we have decided that we do not want to, you know, muck up the system by, you know, trying to value companies that are not ready to be valued. And as a matter of fact, you know, yesterday, one of the companies in our program that joined after they have already raised a little bit of friends and family financing, and we had a private roundtable, and he was presenting, and he has raised $140,000. And he's given up 40% of the company for $140,000 in friends and family financing. This is a very, very bad deal. You know, you guys, those of you who are raising equity, you need to be very careful about how you structure your equity financings, including friends and family equity. Friends and family is the most common type of funding that you're going to get in the very early stages. It is what is the most likely situation of getting a company, mechanism of getting a company off the ground, because what do friends and family do? Friends and family invest in you, the individual. They're not trying to invest in your billion-dollar idea like professional investors are. So friends and family are the ones who are likely to give you the first break, and that is a round that you need to still negotiate carefully so that you don't create a situation where you've given up so much equity so early on that your latter rounds become unattractive. So our thesis on that is you should not raise equity financing at lower than $2 million pre-money valuation. If you're raising money at lower than $2 million pre-money valuation, try to do it with a convertible debt. Now, of course, this is not always viable because we work globally. We also work with a lot of entrepreneurs who are in different parts of the world with very weak seed capital ecosystems. And there, it's an investor's market. Entrepreneurs are at a disadvantage. They don't have that many options. There's no competition for funding and so on and so forth. So they often get stuck with, unappetizing term sheets, so to speak. But as a general principle, keep in mind that you should not part with so much equity early on that you become unviable financing-wise later on. So let's look at a few introductions here. Ortez Good is introducing himself from Corvado, Atlanta, launching a life cycle management solution for buildings. All right, interesting. Vasudevan from Bangalore, India, launching the first online marketplace for coaching. All right. And Mani Doraswamy from San Carlos, working on machine learning platform. And Rupesh is on the call from Oracle. So folks, Rupesh actually is part of the Oracle 1M1M challenge. We are doing a partnership with Oracle right now, and we have an intrapreneurship challenge running at Oracle, and next Thursday is the deadline for applications for the Oracle 1M1M challenge, through which we're going to bring in a chunk of intrapreneurs from Oracle into the 1M1M program for incubating their ideas. This is the third batch we are doing at Oracle, and from the first batch already hundreds of millions of dollars worth of revenue opportunities have been identified from Oracle. So it's very exciting what's happening there. Vasudevan says, in my opinion, most of the accelerators in India are behaving like VCs who provides growth capital. Why aren't accelerators offer risk capital? That's absolutely right, and this is not just in India. See, the moment your business model, if you're an accelerator, think about it. Work with me on this thought experiment for a moment. Think about it as if that you are running an accelerator, right? If you run an accelerator and your business model is equity, then you want to take equity in the most promising companies. So you are looking for the best company that you can find, that is where the risk is the lowest and where you can actually make money off your equity. This is another reason why I think incubation and acceleration should be decoupled from the equity model. Incubators and accelerators should not take equity. If you really want to do incubation, if you really want to do acceleration, you should not be taking equity. Don't you agree with me?
Right, exactly. That's the point.
Yep. Any other thoughts on this topic? Otherwise, we're going to open up another interesting topic and discuss it around, kick it around. All right, let's find another one. So one topic that I'd like to discuss is how to fund a fast startup. This is a very, very interesting topic. Maureen, would you put up the how to fund a fast startup link for our audience, please? And while you are reading how to fund a fat startup, let me also take the comments from the audience. Venkata Motamari says, my name is Kamesh, from Oracle India, and planning to pitch in 1M1M challenge next week, working on building virtual business card app. I have a question. Would accelerators ask for a change in strategy? They could. If you are, if you're doing something that is not validating, it could very well require a pivot, as we call it. The terminology for a change in strategy that the industry is using is a pivot. And yes, that could very well be the case. Why do you ask, Kamesh? What's behind that question? What's driving that question? Folks, again, you have call-in instructions on your screen. If any of you want to participate in this discussion by actually calling in, you're most welcome to do that. Okay, so how to fund a fast startup? And the reason I put that up is, we are very much discussing lean startups these days, and by and large, the 1M methodology is very much a lean startup methodology. We try to coach you to do everything in a very lean, capital efficient, cash conserving method. The reason I bring up how to fund a fast startup is that there are some parts of the startup business where actually to build really serious technology, you do need some funding upfront. And we do get the question is that if I need to build this product, which is an expensive product to build, and this is particularly true in areas such as infrastructure, if you're building a security product, for example, or virtualization, and there's a, storage, network attached storage, there's a whole infrastructure part of the ecosystem. Of course, chips fall in this category. And even some parts of complex, maybe could be personalization technology, could be, different types of machine learning could be at some levels complex. It depends on what you're working on. Sometimes there are, there's need for capital upfront, and I call those fat startups, those that require capital upfront. And what I've offered you here in this post is a bunch of case studies. Again, our whole way of learning in the 1M program is through case studies, as you know. And this how to fund the fat startup introduces you to a bunch of entrepreneurs who have raised money on concepts. And there are a few trends that I see there. One is serial entrepreneurs can raise concept financing, especially serial entrepreneurs who have made money for their investors in a particular domain and are considered domain experts. See, domain expertise is at a premium in the venture capital business. And if you're trying to raise money for something that requires upfront investment, you need to be a domain expert in that domain to be able to do that. Unless you have track record in that particular domain, the likelihood is very low, especially if you're a first-time entrepreneur. If you're a serial entrepreneur, there's a bit more flexibility. If you have existing relationships with investors, they are more interested and more likely to write you checks. But that's, again, a minuscule community. So this How to Fund a Fat Startup article will expose you to a bunch of different mechanics through, again, case studies. So let's see what's happening in public chat. Aaron Mitchell is introducing himself from Los Angeles, California. He's launching a cognitive learning solution for youth and amateur athletes. Wow, sounds very cool. Love to hear more. And Kamesh is saying that he had this question in mind about pivots for a long time and just wanted to get it clarified. So yes, in our program, for example, I'll give you experience feedback from our program. We, as I said, we really truly incubate companies. We accelerate companies as well, but we also incubate companies, and people would come into our program with an idea, and we put them through our validation methodology. We have a very well-formulated validation methodology. Now, if that idea does not validate, we would require that we would advise you to change the strategy. We would say, okay, discard this idea and come up with another one, and take that second idea through that same validation process. So often we see that Maybe even entrepreneurs' first and second ideas do not validate and they actually gain traction on the third idea. And that's fine with us. We are not trying to, kick you out of our program in 3 months as most accelerators and incubators do. We want to really work with you and help you succeed. And whatever time it takes you to do that is fine with us. We are an annual membership-based program. So when you join the program, you join the program for a year and you can renew your membership and continue to stay in the program for as long as you need to and continue using the program for as long as you need to, because just as we have companies in our program that are just starting out, we also have companies in our program that have already, hundreds of thousands of dollars in revenue, or in some cases, several $1 million in revenue. And we are able to help all of those categories just because we've chosen to do a somewhat different model of acceleration, which I believe is much more interesting and much more helpful, actually real value creation in the acceleration and incubation world than what most of these 3-month programs are doing, and they're trying to take equity, and as a result, they're trying to come to the rescue of victory. Okay, any other questions, comments on the fat startup topic? Otherwise, we'll pick up another topic and hash it out. Also, folks, feel free to introduce yourselves, as some of you are doing. This is also a networking opportunity. So tell us who you are, what you're working on, where you're dialing from. How did you hear about 1M1M is something also I'm always curious about. Okay, Maureen, if you could also put up the funding rejection statistics of key players as the next link, that would be great. So folks, what Maureen is putting up for you is another post that is a relevant post in this context. It has the rejection statistics of a bunch of key players in the ecosystem, and they're representatives of their particular categories. So if you open up this post, you will see that we start with Y Combinator. So if you apply to Y Combinator, your chance of getting rejected is 97.15%. It's a very selective program, and all these programs take pride in how exclusive they are and how many people they reject. So for the latest batch of Y Combinator, 74 were selected from an application pool of 2,600. So this is similar to what Techstars does. Techstars also is a very, very selective program. And in general, the reason these accelerators that are giving you money for a 3-month program, the reason they are so selective is because they're all trying to make their equity work. So they are really trying to find those few companies that are already have some traction or have validated a little bit so that their equity really pays off. So in a way, instead of doing actual incubation and acceleration, they are doing screening. The difference between real acceleration and incubation and screening is that if you're doing real acceleration and real incubation, you really have to be open to people who are not ready necessarily to negotiate an equity round and be funded even. This is, if you're doing real acceleration or incubation, you have to be able to say that, okay, you can work with us, but you can work with us even if you're working on a lousy idea, because we're going to show you how to validate your idea, if necessary, how to invalidate your idea, and then we will teach you how to come up with an idea that you can actually build on and make a success of. In my mind, that is real acceleration. The next category I deal with in the funding rejection statistics of key players is Angel List. This is an interesting, Angel List is a very interesting player actually. They've brought together a lot of angels in one social network, and they are doing a lot of funding through that network. Angel List has about 24,000 accredited investors, and there are 85,000 startups who have listed themselves on the site, and 1,000 of them have been able to raise some form of money. And that puts their rejection statistics to 98.8%. So on AngelList, you know, just about 1.2% of the companies are succeeding in raising any kind of money. And our experience of working with AngelList, our companies that have worked on AngelList, is basically you have to go find a lead investor elsewhere, not on AngelList. AngelList works the best if you have a lead investor outside of AngelList, and then come to the AngelList and with a term sheet, with some traction, and then the follower investors get on that bandwagon. That's the best way to use AngelList. And then the third one that I've shared with you here in this article is Andreessen Horowitz, which is representative of the VC class, basically. So Andreessen Horowitz sees 3,000 inbound deals a year, and these are referral deals. These are not even unscreened deals. Somebody's already doing some screening and then sending it to them. And they do maybe 15 to 20 investments a year. So their rejection statistic is 99.3%. So as you can see, this is a very low probability game. And what we are trying to do in 1M1M is to make our program as inclusive as possible. Within the IT and IT-enabled services domain, our program is completely inclusive. Anyone can join as long as you're willing to do the work. We make you do a lot of work. You know, we are like a gym, and we offer you a whole bunch of machines and trainers and so forth, but you have to do the work. And if you're not willing to do that work and put in the time that is required to do the heavy lifting, then we cannot help you. But we will give you the opportunity to study with 1M1M and build your business using our methodology to anyone who wants to take advantage of this program. So now questions, comments on the funding rejection statistics post. Anybody? Any thoughts, any observations, any questions? No? Nobody? Chris from Shanghai, yes, go ahead. Vasudevan from 500 startups, you know, it's very similar. The accelerator statistics are very similar. 500 startups funds more companies because it has, you know, a bit more capacity, but at the same time, they also get a lot more applications. So everything, all of these players are in that 97, 98, 99% rejection statistics bandwidth. Anybody else? Any other questions, comments on this topic? All right, let's pick up another one. So crowdfunding startups, what excites me, what worries me? Maureen, would you put that one up, please? There's a lot of discussion right now out there about crowdfunding. And this post gives you a quick little summary of the things that I'm really excited about and what I'm really worried about. So let me, while you're taking a quick look at this post, let me summarize what I'm thinking here for you. So, you know, crowdfunding promises to bring a much, much larger number of investors onto a crowdfunding platform where entrepreneurs can go and raise money. Now, what is very interesting about this particular method is that just being able to create an investment pitch for a large community of potential investors is interesting, particularly from the perspective of being able to engage your customers. So the case study we offer in there is a company called Modernizing Medicine. And what Modernizing Medicine did, this is a healthcare IT company, by the way, and they cater to various kinds of doctors. And what they have done, it's actually a very interesting, savvy approach to raising equity money. They went and invited their doctor clients to become equity investors in the company. And what that did is it converted all these customers. The customers were already very happy customers. So they brought them in as investors, happy customers also taking equity participation, in the company, converted these customers into very, very active evangelists. And what that does is customers advocating your product to other prospects gives you huge amounts of momentum, leverage in creating compelling traction around your product. This, I think, is a very, very smart strategy. And I think what crowdfunding may allow us to do once equity crowdfunding becomes legal, is that startups may be able to bring a lot of these potential, existing happy customers onto a crowdfunding platform and raise money efficiently around that. This, I think, is one of the most promising aspects of crowdfunding. Now, what worries me, however, is that any time you need to raise a funding round, somebody needs to lead that round. And this is one of the problems AngelList has, is that it's full of investors who don't know how to lead. They're willing to follow a lead investor, but most of them do not know how to lead. And the same thing will happen on crowdfunding platforms. There will be a lot of investors who are willing to follow, but there aren't enough lead investors, enough people who know how to lead investments, how to put a valuation, negotiate terms, do due diligence, all these things that a lead investor needs to know how to do. There aren't enough people who are savvy in doing those things. And that is going to be a bottleneck again. So ultimately, crowdfunding is going to be interesting. I'm sure it's going to be interesting, and it's going to open up new opportunities, but it is going to continue to face the bottleneck of the knowledge gap of, of a lack of savvy lead investors. This is my thesis, or this is my analysis of what is likely to happen. So please feel free to weigh in. Anybody who has a point of view or comments, questions, experiences to share, please discuss, either in the public chat or by calling in. Anybody? Any questions, comments?
I think, one thing I would say is crowdfunding seems to be more applicable for consumer-based products, because they're able to give the incentive that once the product is ready, they will get a piece of it. So when it comes to enterprise applications, I'm not sure if there have been too many success there.
Well, there hasn't been, and for the moment, I would say all the technology-oriented products are very hard to do, because part of it is you cannot give equity, right? What works in the consumer product model is that the consumer is himself or herself is the customer. So let's say you are designing a photo frame and you are raising money on a crowdfunding site, and your promise is to the consumers who want to buy these photo frames, once the product is ready, they will get their photo frame shipped, and they're paying in advance for getting that product built. That is the most common method of crowdfunding out there right now. Now, if you flip that model to an enterprise software situation, the people who are helping make the decisions on enterprise software are not the customers. The enterprise itself is not going to participate in a crowdfunding round. So what you're then saying is that the employees of the enterprise, the decision makers, maybe the technical decision makers or the economic buyers of that enterprise product, they could be funding this product, but since equity crowdfunding is not legal yet, they can't fund these products. Once equity crowdfunding becomes legal, you could have that scenario, although there will be conflict of interest and all that. So unless you are buying a product for yourself, like these doctor's offices is a very good example, where the doctor's office is buying these products for their own office, and if the doctor comes and invests in that company, it's okay. There's no conflict of interest there. But in the case of an enterprise software company, if a decision maker, if a a VP or a middle manager inside the enterprise invests in the company, then there could be conflict of interest issues that will come up. However, I do think there will be possibilities of people participating in enterprise software as well in equity financing mode. People who have strong domain knowledge in an area, I think they will start participating in equity financing for enterprise software as well once equity financing becomes legal. Does that make sense?
Right.
So Mani Doraswamy says, we got our first customer, 36,000 per year last week for the machine learning platform. We are talking to 5 more customers. 2 of them are large enterprise deals. Should we raise money now or just focus on customers? Mani, if I were you, I would focus on customers and get further. If you can, if you are doing something that is sufficiently compelling to be able to get more customers, the likelihood of you being able to raise money is much higher downstream. But I'll caveat that by saying that I don't know what you're doing, so it's very hard to be more specific than that. So as a rule, we prefer that you bootstrap your early stages as much as possible so that by the time you go to investors, you're in a much more mature state. Maureen Kelly says her brother-in-law is crowdfunding his film, Inside Fighter. Oh, cool. This, by the way, is very common. Film financing, there's a lot of crowd financing happening in films. Vasudevan asked, how do startup founders attract investors through some sort of inbound marketing? So in general, financing happens either through your network, you contact people you know, or through your referral network. So somebody introduces you to an investor. You cannot really do inbound marketing and expect people to participate in your funding round. People who don't know you are most likely not going to participate in your funding. Except in a place like AngelList, where if you have a lead investor whom other people know, other investors may come into the round. That is what the crowdfunding concept is all about, is that once there is there's a business that is getting a project that is getting traction, other investors start looking at it, and those are the places where kind of unknown financing from unknown people happens. You can't really run an marketing campaign to attract investors otherwise. PR is a good thing. If you can get PR out there and investors start to learn about you and read about you in credible places, that is one way you can attract financing. So we've had this happen a lot to our companies. We would cover them. We do a lot of coverage of our companies in the portfolio. And once people read about you, a lot of investors contact our companies, and then things start to happen. This is something that we have seen happen across the board, and in all geographies. We've had people doing that in India. We've had people doing that in the Midwest. We had a company in Michigan that we wrote about in Small Business Trends, and they started getting investor calls. Our Deal Radar series and Incubator Radar series are monitored by a lot of investors. So this is a very common happening, is if you can generate solid PR around you, that is going to trigger investor interest. So in terms of inbound marketing, I would say generating PR is probably the best way to do it. So folks, I'm going to take a few minutes and talk to you about how to use 1M1M, and then we can come back and do more of these kinds of discussions, okay? So while I'm doing it, while you're listening to this, also get your questions lined up so that we can discuss some of what's on your mind as well. I'm just bringing up some of the topics that are in the minds of a lot of people right now, and I'm sharing, little posts with you so that you can touch on what's happening in those parts of the market. But I'm sure there are other things that are on your minds, and I'd like to learn what they are and bring them up, highlight them as well in the discussion. Okay, so if you like what we are doing here, by the way, we would very much like referrals. We would like you to introduce other entrepreneurs who are serious and want to make a success of their businesses to 1M1M so that they can be part of the program and leverage its resources. Okay, so everything is at 1mby1m.com. Everything. We are one completely virtual program, and you will find an immense amount of information on our website. Our blog is a free resource which is chock full of very high quality content. It's an incredibly, powerful resource, and you're free to use it any point you want to. We've also published a series of entrepreneur journeys books. These are case study based books, and they highlight a particular topic and discuss a particular topic in depth. And we've published 8 of these books, and all of them are on Amazon Kindle. So the first 4 are available on physical formats as well, and the last 4 are available in Kindle-only format. All 8 are available on Kindle. So these are, again, topics that we believe are important topics, and we continue to highlight case studies around those topics to teach you in more detail about those topics that we believe are important topics in understanding your entrepreneurial journey and learning from other entrepreneurs who've come before you. This is what the site looks like. You probably have been there already. There's a bunch of videos that are essentially video FAQs that explain to you what the 1M1M program is. We do these free roundtables every Thursday morning at 8 a.m. Pacific time. So please continue using them. This is our 205th roundtable. Thousands of entrepreneurs are using this program and coming by and asking questions, working on their. We do slide presentation and mentoring based on your presentations as well. So that, in fact, is the core format of these sessions. Sometimes I'll do what we are doing today is pick up topics that are, top of the mind and hash them out a bit. You can go to the website under the free public roundtables page and find the entire schedule as well as registration links for each of the roundtables. You can register to pitch or register to attend. On top of that, we have our premium program, which is a $1,000 annual membership fee. We provide you with extensive methodology guidance. We have a curriculum that is very detailed and very well structured. We help you with business development, introductions to customers, channel partners, investors, media, analysts, advisors, and we do strategy consulting sessions over WebEx for our members. These are members-only sessions as part of the program as well. And as I said, it is a 1-year annual membership fee that is renewable. So you can use the program for as long as you need to keep making progress. On our website, the $1 Million Club link will introduce you to people who have crossed $1 million in annual revenue in the program. We also give you an ROI analysis of how we quantify the 1M1M value equation, and that ROI is $375,000 plus 5 to 10% equity according to market rates, and we give that to you for a $1,000 annual membership fee. There is no program of this caliber at this price anywhere in the world, and we are a proven program at this point. We give you plenty of orientation material on how to use the program effectively, and as I said, it's like a gym. Just by buying a gym membership, you're not going to succeed, but if you use the program effectively the way it's designed to be used, you will be able to extract tremendous value out of the program. The self-assessment is a link that is available from the website, and we recommend that you put yourself through the self-assessment because it's a very systematic, structured way of thinking about your idea and your business strategy. If you're in the premium program, the curriculum modules attached to each of these bodies of questions are going to help you plug your knowledge gaps. There's tons of information about what to expect from the premium program, video FAQs and so forth, so feel free to go through them. And Maureen, could you also please put Irina Patterson's phone number, email address, and Skype ID in the public chat so that if you want to call somebody and talk to her about your business and how 1M1M applies to your situation, you can do that with Irina. Now, A bit more about the curriculum. We have had over 600 experienced, successful entrepreneurs come to the program and develop case studies about their journeys, their lessons from the trenches, and we have stitched all this together into a very powerful, inspiring curriculum that is delivered as case studies and video lectures. So you have all of that accessible in web self-service mode. You can do that at your own time. We have divided the curriculum into a core and an elective. The core is bootstrapping, positioning, market sizing, customer validation, financing, customer acquisition, and team building. You have to master all of these aspects to build a successful business. And then on the elective side, we have Web 3.0 and e-commerce, cloud computing and business solutions, mobile and social apps, healthcare IT, online education, gaming. These are the topics under electives. Our methodology, as I said before, is lean, capital efficient, bootstrap startups. And we will always ask you to do as much as possible in this mode. And if you are welcome to raise financing, we will help you raise financing. We are deeply connected into the financing ecosystem. But to get the right terms, to be, to not become a rejection statistic, it is really essential that you do as much as possible in a bootstrap mode so that when you go out to raise money, you put your best foot forward, and we'll try to get you as far as possible in this mode, including help you get media coverage. So media coverage, as I said, is a very good way of generating inbound interest from investors as well as customers and just establishing credibility. And we have a lot of clout in the media. We put that clout to work on your behalf so that when you get out there and you start generating leads, both customer leads and investor leads. And almost without fail, our companies that are getting media coverage through 1M are generating lots of business through that process. We also let you use our social media channel. This is a very, powerful social media channel. Lots of, we have huge Twitter following, huge Facebook following, LinkedIn following, and we let you push your messages through our channel. And again, it takes a long time to build a large social media following, so being able to ride on top of ours is a benefit that we offer to our members. The Incubation Radar and Deal Radar series that we cover on our blog are coverage that investors often monitor. So we encourage you to get covered in those series, and our customer support team will work with you on that. So that's 1M. If you have any questions, please feel free to ask in public chat. Maureen has put up Irina Patterson's contacts, irina@1mby1m.com. Her phone number is 786-301-2456. Her Skype ID is irina_Patterson, and she will be happy to talk to you and explain to you, answer your questions about joining the premium program. Mani, you are asking, I saw that you were doing a webinar series for Salesforce App Exchange Accelerate program. Can you tell us about it? It's an invited talk, basically. So Salesforce often invites me to do stuff with them. I spoke at Dreamforce. I was on a panel with them on acceleration, actually. And this one is about their App Exchange Accelerate program. So we'll talk mostly about what's happening in the enterprise software ecosystem, where are the opportunities, what kinds of things are interesting right now, and so that's roughly going to be the discussion. So I have a meeting actually later today with Salesforce to thrash out what specifically we're going to do. So come to the session, and we'll talk about more interesting stuff. Folks, those of you who are working on incubating entrepreneurs in different parts of the world, or fostering entrepreneurship ecosystems, please also note that we have an affiliate program, and we are a very flexible partner. We're very happy to partner with you. We have an affiliate program that offers 10% affiliate commission. We have a bunch of free roundtables coming up, and we have some partners working with us on these roundtables. So on February 20th, we will have a bunch of startups coming from Startup Weekend Jacksonville. So we are partner with Startup Weekend chapters from time to time. We have a Penvention. This is it UPenn, Maureen? University of Pennsylvania, that's doing an entrepreneurship summit, and this is a mentoring session for people participating in this University of Pennsylvania contest. And then these are semi-finalists of the contest who are going to be coming to a roundtable for mentoring. And on March 6th, we have a custom roundtable with Autodesk Developer Network entrepreneurs. And then March 20th is back to an open roundtable. So, you know, these are, again, things that we do from time to time with specific partners, where we will have custom roundtables for specific communities in different geographies or different universities or different platform ecosystems. And like our Autodesk, for example, we have a partnership with Nokia around the Lumia Windows platform ecosystem developers. We have a partnership around SAP HANA platform developers, so on and so forth. And as you know, we have a partnership with Oracle Intrapreneurship. Those of you who are
Sramana, you mentioned for last year, Oracle, there was some product that is now generating 100 million revenue.
Not generate. It has identified, after the incubation process, we have identified a couple of opportunities that are hundreds of $1 million worth of revenue opportunities. So now they're going to go on to the next stage, and the process is they're going to go into discussions with Oracle management, and Oracle will decide on what to do with that revenue opportunity and how to take advantage of it. That's the stage they're in right now.
So the team would be mentored by your organization, or how does that work for Oracle?
Right, they have been. They've been in the program for a little over 6 months, and they have been incubated to this stage, and they'll continue to be mentored further. But in the meantime, they're already ready for the next level of discussions with the Oracle management, who will then take the decision on where they're going to sit. So, for example, one of them is a logistics product, and it's a warehouse management system related product. So Oracle already has warehouse customers, and this product could very well become an add-on to the products that the existing warehouse team are selling. So this is most likely the direction we're going to be steering this particular team in. Another one is an HR product, and that one is probably going to get grafted somewhere in, you know, Talio or a group that is already selling HR related products. Does that answer your question, Rupesh?
Right. So the team still continues to be in the current organization, or does it have to? How does that work? Do you have any idea on that?
We don't know yet. We'll find out. So these presentations are coming up in the next 6 weeks, and we'll see what happens after that and what decisions Oracle management takes.
Right.
The first order of business is you have to come up with a compelling business idea that is fully fleshed out following our methodology, so that the Oracle management can look at that idea and evaluate that idea and decide what is the course that they want to take with it. This is the path that we're following.
Right.
So folks, those of you who have not come up with an idea yet, especially if you're in a developing market, you can look at this Vision India 2020 book. It's not just India, it's basically ideas that apply to developing economies. And there are 45 ideas in there, and you're welcome to take any of them and build on it, derive ideas of your own. It uses a technique called visioning, which is a very powerful technique of ideating. So the incubator in a box, by the way, is a product from 1M1M, which allows any company, investor, government, school, entrepreneurship development organization to start their own incubator or expand the capabilities of their own incubator. So this is the program that Oracle is using, Nokia is using, SAP is using, and a variety of other partners of ours are using. These are a bunch of books that you've just encountered. These are the new books, the latest books actually, the last 4 books that we released over the last 4 months. And back to Q&A. If anybody wants to call in or ask questions in public chat, please feel free. Anybody? Questions, comments, introductions? Feel free to introduce yourselves as well. This is a very non-threatening, safe environment. So, you know, we are your friends. We are not here to judge you, or we're not here to. It's a platform for constructive feedback, input. So, using which you can make progress. That's really the whole, you know, purpose of our existence. All right. Well, if there are no questions or comments, then we'll wrap up the session, and we will be back here next week with another, you know, free roundtable. And this time we're going to have people coming from Florida. We're going to be hearing from a batch from Florida and Startup Week in Florida, Jacksonville, and we look forward to meeting them. Thank you very much, everybody, for participating, and I hope you enjoyed the session. Bye.